Here are the below examples that we already seen. I will not go through because we in the previous session we studied in detail. This is the no interest capping rule on the following person, on the following taxable person, on the following areas or following activity. So this is again, I added over here for better understanding. What are these points? No interest capping rule on following. No interest capping rule, no ILR interest limitation rule will be calculated or applied for on whom natural person, whatever loan he have for his natural own personal activity, as long as what are the personal activity? Personal investment, real estate income. So if he taken the loan for his personal activity, so interest capping rule will not be applied. But here the important part, if whatever the activity natural person is doing without trade lessons or do not require the trade lessons, then it will remain the natural person. But if he's doing some activity via trade lessons, or even he's doing activity without trade lessons, but that require the trade lessons, this is a very thin critical area or critical point we have to you guys to focus. Natural person doing some activity, business activity that do not require the trade lessons, and he do not have the trade lessons is fine. Okay. But a natural person doing some activity that is not that require trade lessons, but he do not have the trade lessons, that's subject to corporate tax. And the second is the financial institution, bank and insurance companies, no interest capping rule. The next is the historical loan. Historical loan also in previous session we discussed. Historical loan taken on or before 9th December 2022 for the big public for the big companies who do involved in the construction like the Expo or the another Etihad Railway or any other public projects, they normally take the historical loan for the to support the public projects. We already go through the qualifying projects. We will not spend more time over here because we already seen. Now we'll continue the next part. Here we are going to discuss the dividend. Point number 3 of the Article 33 out of 12. Out of 12, the point number 3, dividend or profit distribution to the owner. Now, what are our understanding? The dividend, it will be company expense. Would you guys please quickly respond? Dividend is the company expense or no? Is there any specific scenario where such dividend will be our expense that we will deduct in the profit and loss? Is there any specific case where the dividend paid to the shareholder would be our expense and we will deduct from our income statement? Is there any understanding that you guys have? Because this is the point we wish to understand today. The whole topic of understanding is in which scenario we are paying the dividend, but it would be our expense. Just now, one of the participants mentioned the redeemable shares, redeemable preference share, redeemable preference share. Who will understand that? This is the such dividend that is paid on the redeemable preference share would be interest, and that will be part of calculation of the net interest. So that dividend that by name is a dividend but actually is the interest on the redeemable preference share, that we will do add up into the net interest calculation. Whatever the amount of dividend paid, we will add into the net interest calculation. Interest capping rule, that will be part of interest capping rule. how much will be deducted and how much will be carried forward for the next 10 years, that will be part of our calculation in the interest capping rule. So this is the point we wish to understand today. Okay, here if we understand, okay, let's move in the same way. So first we familiar with the shares. Okay. So shares, normally we are familiar with the equity. Now we are here separating into equity and debt, because some share will be equity and some will be the debt. Now let's understand what are the equity and what are the debt. If the equity shares are the redeemable and debt equity shares are irredeemable. Equity shares are irredeemable. On the other side, debt share are redeemable. This is the one of the point understand earlier already mentioned next. So on redeemable share, we will pay the dividend by name, but actually the interest, that interest will be part of the interest capping rule. When we calculating the net interest, so from this interest will be adding over there. Now how the tax accountant or the tax consultant will know this dividend is actually the interest? Because in reporting, it may be not mentioned over there. If even this is the another current scenario of the market, the most of the auditing firm, they are not giving the appropriate disclosure in the audit report also. Even they are issuing the report without having the proper disclosure as per the IFRS, as per the applicable IFRS, where they are required to have the full disclosure. If they such disclosure are not there, so for sure the tax accountant or tax consultant will make mistake over here. That is not by intention, because he do not have the sufficient information. So this point, the accounting team must be known. The accounting team must be known. The GL accountant must be known. The reporting team must be known. So what they have to do, they have to highlight this. They have to highlight this. They have to make chart of account arrangement. So such dividend will be go to the interest capping rule, into the interest expense. Or they might open the dividend as the interest, another chart of account, or they put as a sub ledger of the main account. So if we align our chart of account in a way, the information will be directly going in the appropriate way. When they take out the information for tax purpose or the tax audit, so this information will be available. Why we have to adjust the chart of account? Because even the financial statement is prepared, the reporting person is prepared. But after 7 years, if somebody come back dated 7 years and open the financial statement and he want to trace from where this expense is coming, this would not be easy, because the same accounting team will not be available. If the same accounting team will not be on place, the many story will be changed. How we justify, how we give the supporting. So now we are discussing the traceability. Now we are discussing the traceability. So the traceability is another important part. If we link the chart of account, our traceability of the expenses or item or revenue will be improved. And even none of the previous accounting team members are there, but as quickly anybody can take out the data from the financial statement or the accounting tool, whatever the accounting tool you are using. So this is the importance of the chart of account. If you customize or align the chart of account considering the tax limitation, it will be helpful, not in the recent year, in the current year, but in the future also, to avoid inconvenience in the future also. Okay, before that, we are seeing the irredeemable dividend is optional. This is not mandatory. We have to pay, but redeemable is mandatory. Here the dividend interest is the expense, but on other sides, the dividend optional, and this is not the expense. It would be go to the statement of change in equity, not in the profit and loss. This is the summarized version. This is summarized version that for the dividend or the expense dividend on redeemable shares, that we're considering the interest. But I have the in next slide the detailed clarification or detailed understanding to understand this concept. We will go on that also. But here we have some other example also. But before that, the business raise the finance. How they raise? Equity finance by the owners. This is equity finance by owner. Okay. Permanent from equity finance by the owner. This is the what are the advantages or what are the characteristic of such finance? It would be permanent source of finance, no maturity date, discretionary payment, which means is optional. Once the company make the profit, they will make the board will discuss and announce the dividend. It's not mandatory to pay, and is irredeemable preference share. Irredeemable preference share. Cost of equity, dividend optional. Here we understand the owner equity finance. On the other side, if we see this part, the debt part, if we're raising the finance for the company from this part, so what are the characteristics of that? What are the options for that? Debt finance other than the owner. Bank loan, redeemable preference share. The word redeemable means normally we have the vouchers, redeemable vouchers, and many practical life we are having the vouchers. Maybe the care for and Lulu, they also giving the gift voucher, that is a redeemable gift voucher. You can use in any care for, or you can give that gift voucher to any of your friends or any of your relative if they want. You want, instead of giving the cash, you can give them such vouchers. They are small cards. So this is the example for understanding from our routine daily life. Issuance of school bond, debenture, notes, leasing of assets. But these are all temporary source of finance. These are all temporary source of finance. What does that mean, temporary source of finance? Because there is a maturity date. For all this loan, there is a maturity date. We have to return this loan. Just for our understanding purpose, we will give you the example from our another practical life or the personal life. Just assume that the equity finance you taken anyone wish to start his own business, he took the loan from his parents, his father. So once and you took the loan from your father and you start your business, is your father will come and ask again and again, okay, give me the money. Versus you taken the loan from one of your friend or another relative. So they will frequently come and ask, okay, where's my money? When you will give me money? So they will keep reminding you because ultimately you have to pay them. You have to give some compensation also. But on the other side, the parents, if you took the loans, they will not ask. They will say, okay, we already spent a lot of money on his education, on his other career. So that also may be capitalized or maybe expense out of the sunk cost. So this will be another cost that may be not recoverable. They just put some assumption on this way, and they will not bother to keep reminding for the refund of the finance. This is just the understanding purpose. The example is quoted. So normally now we'll move to the next, and we'll see in the next slide what are the further detail over here. Okay, now our third expense is the entertainment expenses. Now our entertainment expenses. So I wish if you guys give me the some of the example is mentioned over here. And earlier we also understand what are the entertainment expenses. The applicable article for the entertainment expenses is the Article 33 of the city law. Normally we are familiar, okay, the lunch or the some annual dinner or some meals or something, or the transportation or air ticket or admission of gym or movies. Something like that we are giving to the employees or to the customer, to the partner, to the vendors, and different stakeholder in the business. Yes, colleague, annual party. Maybe another example also will be there. So mostly these are the some of the example, but in each business there were different example. So we have to see what are the allowed and what are the disallowed. So here we already go through the customer, owners, partners, suppliers. These business stakeholders is disallowed. These are the business stakeholder is disallowed. No need to check the private element. If we did the entertainment for such stakeholder, it will be 50% disallowed. On the other side, the staff and the employee entertainment expense 100% allowed. Okay, here we've seen the example financing of business, understanding example through equity and finance. We already understand, but now let's move to the next part. Next slide and see the here what we gonna see? What we gonna see? This part shares for the point number 3, item number 3, dividend. Under that, we're gonna understand the shares. This is the important part. I already gave you summarized version, but let's see that in detail also. Okay, the shares normally we are familiar with the ordinary share and the preference share. This is not the performance, this is the preference share. The type order is there. The ordinary share, and now we will see under ordinary share is the shareholder have the voting right, and the preference share dividend liquidation. In terms of the preference share, they have the favor. Yes, please, Mr. Hamza, if company is paying the subscription for the employees also, that also considered in the entertainment category, also employee allowance also. And like gym, we already mentioned the word gym, so normally the gym membership are annually. The preference share, what are the favors? The preference share, they will get the dividend. They will have the preference in the liquidation. During liquidation, they are the first shareholder who will get the liquidation amount in case of any loss, but they don't have the voting right. They don't have the voting right. Versus the ordinary share, they have the voting rights. They have voting rights. Now the preference share, redeemable and irredeemable. Okay, here again the preference share, there is a two category. Why we are understanding in the previous slide, we have just summarized version, and here we are understanding the redeemable preference share and the irredeemable preference share, and this is the ordinary shares. Hope you guys are with me understanding this point, catching this point. Now the irredeemable preference shares are the equity, no repayment. Redeemable preference shares are debt and the liability. Shares are recoverable and recoverable. This is again here we are linking here ordinary share, they have voting right, and these shares are recoverable and irrecoverable. The similar pattern here, the preference share we are discussing redeemable and redeemable. Now here's another point, the equity versus debt financing. Business need the cash for working capital or for expansion or extension of the business and increase its presence in the geographical location. So how they will raise the finance? The equity finance or the debt finance, we already understand by honor issuing of share, and here other than the honor, debt finance. Normally they take bank loan, issue of bonds, post debenture. We already seen the summarized version here. For understanding purpose, we are ending here. And let's complete the debt finance, then we'll come to the equity finance. Now here we're seeing the equity finance by owners, issue of shares, permanent source of finance, no maturity date. This is the discretionary payment, cost of equity, dividend, optional. Dividend paid, not expense. Here we are paying the dividend, but it would not be expense. It would be called distribution of profit. So which means if a distribution of profit, it will not go to the income statement. It will not go to the income statement. It will go to statement change in equity. Versus here the temporary source having maturity date. we raise the money from bonds, scopes, debenture, notes, or leasing of the asset. These are the temporary source, have this fixed maturity date, we have to return. And now this is the discretionary payment, compulsory, we have to return these funds. This is not on the equity finance, these are the optional. Here we are seeing that this is the fixed and the fixed plus variable, fixed plus variable. So this will go to the income statement. This will go to the income statement. Interest paid is the expense. Okay. Here we are paying the dividend, but we are paying the interest, but we are calling the dividend. Redeemable preference shares. We are paying the dividend, redeemable preference share. We paid the dividend, but actually the interest expense. Okay, now here we added this couple of points. BEPS model, interest capping rule, encourage equity finance and discourage the debt finance. We already understand this point. Again, I'm adding over here. Dividend paid on redeemable preference share is the interest expense. Actually, it's a paid dividend, but on the redeemable preference share is the interest expense. Dividend paid on irredeemable preference share is not interest, not an expense. Before that, here we the same point number 3. We have the further clarification. We put the continue, and for the understanding purpose, we go through this part.